Hey everyone, welcome to our Composer webinar on US LLCs, partnerships, and tax considerations for Canadian traders and investors. I'm Michael, a product marketing manager here at Composer, and I'll be your host for the next hour. We're thrilled to have tax professionals from Trowbridge with us today. I'll let them introduce themselves. We have Romita and Brandon. Welcome.
Thanks, Michael. Brandon Vucen. I am a tax director specializing in U.S. corporate tax at Trowbridge in our Toronto office.
Hi everyone, my name is Romita Darshani. I am the Senior Manager of the US Corporate Tax team at Trowbridge, a tax service provider. It's headquartered in Toronto. So I just want to kind of elaborate. At Trowbridge, we help our clients with the tax planning needs and ensure they are compliant in a tax efficient manner. Both Brandon and I have assisted clients across various industries when it comes to cross-border tax. We collaborate very closely with our global tax team to ensure that our clients' tax needs are not just seen from the US side, but also from the global perspective. Personally, my focus is always US tax compliance work, and that includes like filing income tax returns at federal and state level. Both of us actually are really happy to be here to talk about some important tax matters for Canadian businesses that are either planning or actually already doing business in the United States. So yeah, back to you, Michael.
Awesome. So the first question to you guys is, what types of US entities, whether it's LLCs, partnerships, etc., would you say are commonly used by Canadian traders and investors?
Yeah, thanks, Michael. So let me first just a little housekeeping before we get too deep into this. Just a bit of a disclaimer. Just want to say this webinar is for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. Not that, what we're going to talk about is valid and hopefully you find useful. However, a lot of the time in these situations, one always has to consider kind of the facts and the circumstances of an individual or maybe an entity that's looking to invest in the U.S. So a lot of the time you really do need to kind of dig into the minutiae, and again, the one structure may not be the same for everyone. Again, depending on their own kind of situation. So as Michael mentioned, in terms of the type of entity, you may want to consider investing in the U.S. Unlike Canada, that only has partnership structure, and then you have a corporate structure like a limited company or an Inc. company. The U.S. actually offers multiple different types of entity structures. Some may not be applicable to non-residents of the U.S., but the one that most people tend to gravitate to, and most lawyers and accountants in the U.S. Is a limited liability company. So what we obviously call an LLC. There's also a limited liability partnership, but which is very, very similar to an LLC in terms of taxation. So we basically would talk about them together. So as they do in the US, an LLC is great for US resident investors because of the nature of the LLC. Unfortunately, an LLC for a Canadian resident investor is extremely bad because it basically results in double taxation. So from a US tax perspective, an LLC is considered a flow-through entity, and just as it sounds, it basically means any of the income and expenses in the LLC flow through direct to the LLC member, and then that individual would report that income on their personal tax returns. Unfortunately, from a Canadian tax perspective, an LLC is considered or is treated as a distinct legal entity. So essentially there's a mismatch between the tax treatment in the US and Canada, and this can basically result in double taxation for any Canadian investor that invests in the US through an LLC. Romita will kind of go into kind of further detail in terms of the tax issues, but again, it's always good to know that anytime it mentions an LLC for a Canadian resident, it's a bad investment vehicle. And we do see sometimes a lot of clients that may start off with that way, and then you sort of have to kind of restructure things to otherwise get them out of that LLC structure. So it is doable, but always nice to kind of set things up properly in the first place. So another type of structure is a limited partnership. So something similar that you would obviously see in Canada. People in Canada be familiar with that. The tax treatment on the US side is similar to an LLC. However, you do get the flow through tax treatment in Canada. So essentially the benefit is you're getting flow-through treatment on both sides of the border, so there's no double taxation. So obviously it's preferred to an LLC. The limited partnership structure is a little more complicated in that you need to have a partnership agreement. Then you also need a general partner as a function of the limited partnership, which is usually a USC corporation. So you can see it's, already you're dealing with kind of multiple entities and dealing with kind of those costs to, kind of maintain these separate entities, and also on the compliance side. There's also so beyond limited partnership, now we kind of get into the corporate entities. And the first one, so a C corporation in the US is similar to what a limited or Inc. company would be in Canada. And this, again, as a distinct legal entity, the C corporation is subject to tax. So the reason why people in the US don't like using a C corporation is because it does result in that kind of initial layer of tax where the income earned in a C corporation is taxed at 21%. And then kind of the net after-tax income in there is then distributed to the shareholder. And then unlike Canada that has integration between income, owned outside of a corporation and otherwise earned inside a corporation where there's an ultimate dividend, the U.S. doesn't really have kind of proper or adequate integration in terms of that type of income. So again, between a partnership and a C corporation, the C corporation, ultimately you're going to be paying a higher level of tax because, again, you don't have the integration, and again, there's that initial layer that you're paying up front. The other downside of the C corporation is that all income earned within it is taxed at the same rate, at 21%. So there's no sort of preferred tax rate on, let's say, a qualified dividend or, let's say, long-term capital gains that a individual may have access to. That income is otherwise taxed at the flat tax rate of 21% in the U.S. It also bears mentioning that once, after you pay the corporate tax to C corporation, the dividend that is ultimately paid out to Canada or to the Canadian resident shareholder is taxed at ordinary tax rates in Canada. So again, there's no kind of a preferred tax rate, or let's say you're not getting a dividend tax credit on an eligible dividend, which results in a lower tax rate. You're basically paying tax on the dividend at your ordinary tax rate. So if someone, if their marginal tax rate is 50%, then you're essentially paying 50% on that dividend from a U.S. company, whereas otherwise, let's say from a Canadian company, it may have been, again, with the dividend tax credit, it might be at 35 to 40%. So it definitely does make a difference. There actually is a mechanism to kind of convert that, the dividend that's taxed at ordinary tax rates to convert it to an eligible dividend. But again, that comes down to, let's say, the individual Canadian resident, whether they otherwise might have a holding company set up. They could always set up a holding company, but there can always be a mechanism where a Canadian resident has a Canadian corporation, which would otherwise own a U.S. subsidiary, which would otherwise be investor. And in that scenario, you're basically sort of converting the dividend from a non-eligible dividend to an eligible dividend in Canada that ultimately flows up to the shareholder. And there's other little nuances in terms of, the income has to be considered active business income, which it may or may not be. But again, it's someone, depending on the amount of the investment, that it might make sense to actually kind of consider that potential option. The U.S. also has something called an S corporation. So basically, it's a C corporation or LLC that can be elect to be taxed as an S corporation. So it's similar to an LLC where there's flow-through treatment for the shareholder. Again, it's great for a U.S. person, but an S corporation cannot have any non-resident shareholders. So again, it wouldn't really apply to Canadian investors. But the one potential advantage is maybe if someone, let's say if a Canadian investor otherwise moves to the U.S., then they might otherwise be able to, elect to make that an S corporation, and then again they would have a better tax situation. But again, for Canadian residents, it's not really applicable.
Thanks so much for those insights. Actually, just a follow-up question there. Does the state of which the entity is, does the state choice matter? Like, if somebody put their entity in Delaware versus Wyoming, does that matter for Canadians if they're thinking about creating a U.S. entity?
Yeah, it can. I think Romita's going to touch on it a bit later. But it can. So depending on kind of the nature of the business, you might have potentially state income tax to deal with. So Wyoming, is a no, not subject to corporate tax. Delaware, if you're not operating a business in Delaware, then you're not subject to Delaware tax. So it can, again, it depends on the nature of the business, whether you have physical presence in a particular state. So it may otherwise have an impact. And now that, in that scenario where your, federal tax rate is 21%, maybe you have an additional state tax of 5%. So now all of a sudden that additional layer of tax that you're, is maybe 25, 26%. But I think in the, kind of the investment, kind of the nature of the investment, I don't think that would have a significant impact. But again, it is somewhat, fact specific.
Got it. Perfect. And I think that leads us into the next question, which is which factors should Canadians weigh when deciding, between the structure for their U.S. entity?
Yeah, so it really comes down to kind of a cost-benefit analysis for an individual. The limited partnership or investing through a limited partnership is advantageous from kind of managing the tax rate that you're otherwise going to be paying. So it ultimately depends. So again, you're paying tax at a lower rate, but in that scenario, then a partner Canadian individual that's a resident in that U.S. partnership, then they would have to file, or they may need to file a U.S. individual tax return. And then some people in that scenario, they don't like to be, on the radar of the IRS. They would have to get like an individual taxpayer identification number called an ITIN, certain costs to that. So it depends. It really comes down to the individual as to whether, again, they want to be filing an individual tax return in the U.S., which would ultimately result in a lower tax rate for them. Or if they don't want to do that, then they would go the C corporation route. But again, they need to know that they're going to be paying a higher rate of tax. So it really comes down to the kind of that decision. They also need to consider, and as part of that, to consider what is their, in Canada. What is their marginal tax rate that they're paying in Canada? Is this someone that, is already at the let's say in Ontario, maximum rate of 54%? Are they already paying, if they're at a lower, if they're only at 35, 40%, then it might make it a little bit different because then, the ultimate income won't be taxed at at the highest rate, let's say in Canada. Again, with corporation compared to a partnership, there's a little more compliance costs involved. So again, it's kind of that cost benefit of how much it's going to cost to incorporate a company, kind of the annual maintenance, required. There's potentially filing fees at a state level that someone might need to do with a corporation. So again, it's a number of again, it's the tax rate and then kind of the additional costs that someone needs to consider depending on this on a particular investment vehicle.
Got it. And I guess the last question for this section is, I think you kind of touched on this already, but depending on if a person is trading personally from Canada versus like actually setting up a U.S. entity, when would you say is actually beneficial to actually start thinking about setting up a U.S. entity versus trading personally?
Yeah, I guess, firstly, kind of from a regulatory perspective, right, as to whether the individual, whether they can trade personally. If they are able to, then that usually is, that is the preferred. It is preferred because, again, you don't need to worry about, kind of the flow through issue and also the additional, taxes with the C corporation. And then you've got, your compliance costs would be less. But again, if you're investing personally, then again, you need to file U.S. tax return as a non-resident. So again, it kind of depends on that. But again, ultimately, from a regulatory perspective, if they need a U.S. entity, then again, it comes down to kind of the same decision, right, as to whether you want to invest through a flow-through entity like a partnership or a C corporation, where again, you've got that additional layer of tax. So again, the decision kind of comes down to that.
Okay, awesome. Let's move on to the next section then, about tax implications and kind of like that cross-border interaction. So what would you say are the main tax implications for setting up a U.S. LLC or partnership, or some of the other entity structures that you mentioned previously, as a Canadian resident?
Yeah, so I'll take this question. So let's understand what an LLC is before we look at the tax implications of various entity choices. So just be mindful that LLC is unique to US, not Canada. And reason is because it's quite versatile as an entity choice to do business in United States. Because LLC, if it's a single member owned, then it's treated as disregarded for tax purposes. But if it's multi-member, then it's treated as partnership. And there's also an option to check the box to treat the LLC as a corporation. So an LLC, like depending what your objective is, you can use LLC in very different ways. And LLC has attributes of a corporation because it offers this personal asset protection from legal perspective and provides tax benefits of a partnership or a flow-through in the U.S., meaning the income earned by the LLC is treated as if it was earned directly by the owner, and therefore that LLC income is taxed once in the hands of its owner. Versus a corporation, it's seen as a separate entity for tax purposes. It's subject to corporate level tax. If the shareholder ever plans to withdraw money from the corporation, then it has to be in the form of a dividend. And then that would be taxed in the hands of the shareholder, which is at the personal level. So you can see it creates two layers of tax, first at the corporate level and then at the shareholder level. That's why the LLC is quite popular in the United States, because it provides all this flexibility as an entity choice to do business. Now, by contrast, Canada considers LLC to be separate for tax purposes. It's like a corporation rather than a flow-through in the US. So there's a mismatch of entity classification here. Canada sees LLC differently than the US. So if a Canadian sets up a US LLC, then they must be aware, as Brendan mentioned, it may not be advantageous from the tax perspective, because there are some common challenges that a Canadian would face. Brendan already mentioned it. The first one is the double taxation of the income, the LLC income. Once the LLC income is taxed in the hands of the US, and then again, when the profits are sent back to Canada, it's taxed in Canada. Another issue that arises from this conflicting treatment of LLC is access to the tax relief provisions in the treaty. Generally, under the treaty, there's FTC to reduce the risk of double tax. But due to this mismatch of entity classification, this treaty benefit may be denied. And another thing that you need to be considered is that whenever LLC sends profits to Canada, there may be reporting and withholding obligations on that distribution, which is at a 30% rate. But under treaty, the rate can be reduced to 5 or 15%, depending who the shareholder is. If it's a parent Canadian company, then 5%. If it's an individual shareholder, it can be 15%. And there are possible solutions here if you already have set up an LLC, and that would be to check the box election to treat the LLC as a corporation, and that's by filing this Form 8832 with the IRS. Now, if you haven't set up an LLC, then the alternative would be to form a limited partnership, for example, because its flow-through nature is respected in both Canada and in the US, so it does not have the same problem as the LLC. And then you can go with the traditional corporate route, which Brendan already mentioned. So the general rule here is direct ownership of LLC by Canadian resident is not a good idea. But if you have already set up an LLC, then there are possible solutions, but that would involve complicated cross-border tax planning, and you need assistance of a tax professional and even your legal advisors.
Got it. And during this process, do you see any common pitfalls, from your own experience, any common pitfalls or mistakes that you see Canadians run into?
Yeah, before we dive into this, one must understand that US has this multi-layered tax system and reporting requirements. There is this federal level, which is the top level reporting. And then there is state or local. It can come down to city level tax. And based on my experience, I have dealt with clients who jump head first without understanding the ramifications of all the actions. And one of the most important components is the tax compliance. Overlooking tax obligations can always result in hefty penalties for being non-compliant. And another reporting that I just want to mention here is the annual report filing with the state of formation of incorporation. Just connecting back to your question, U.S. entity, U.S. entity is generally incorporated under the state law, not federal level. And there's always an annual franchise obligation, which is technically a legal filing and it's not an income tax filing. And I have seen many times taxpayers, they overlook this reporting. So these filings are generally taken care of by your registered agent. So it's really important that you communicate with your registered agent that these reportings are done and not missed, and it's done on a timely manner. Because if not, then again, there's penalty and there's risk of being forfeited to do business in the United States. And there's a process to get your account in good standing with the Secretary of State. Brandon, do you want to add anything here?
Yeah, I would just like to, I would say the most common and probably the most critical mistake is when a Canadian person invests directly in an LLC. So again, a lot of the time, they've got a friend, a partner that maybe is looking at starting a venture in the U.S. and they just go ahead and set up an LLC, and then the Canadian 6 months or a year down the road doesn't realize, kind of the negative tax consequences for them. So that's usually, I would say, the most critical and probably the most common one that I do tend to see. Again, just because an LLC is such an important vehicle that people use in the U.S. So, and again, as Romita mentioned, for a person like that, there's always some restructuring that can be done in that scenario. But again, that tends to be, costly. So the ideal is you like to have it set up properly right from the get-go.
Makes sense. And would you say, in terms of just elections or filings, are there any essential forms that you need to stay compliant, that you need to fill out to stay compliant on both sides?
Of course. The specific forms, for example, if your Canadian business is operating in the US through a US corp, then you have this annual filing, income tax filing, which is the filing of Form 1120 with the IRS. And that's done on an annual basis. And if the US company have a transaction with its foreign related party, there could be additional disclosures such as filing of Form 5472 correctly, or it's missed, there is an automatic penalty of $25,000 per form. And as I mentioned, if the US sub ever distributes dividend to its Canadian parent, then there is additional reporting and withholding obligations on that distribution. It could be the default rate is 30%, but under treaty it could be reduced to 5% with the IRS. And another reporting that I quickly want to mention is the FBAR reporting, the filing of the Form 114. And this form must be done if the U.S. person has interest in foreign financial account and has more than 10,000 in USD at any time during the calendar year. And this reporting is not filed with the IRS, but with the FinCEN, which is the Office of the Financial Crimes Enforcement Network. It's a Department of Treasury separate from IRS. So just be mindful of these reportings. And if you're filing as a partnership, then the form is 1065. And then you need to complete the Schedule K ones for each partner to allocate the partnership income to the partners.
Yeah, sorry, I just like that, and just to sort of reiterate, I guess, what Romita said. From U.S. tax perspective, the compared to, let's say, Canada, the penalties that the IRS may impose are fairly draconian. There are some ways to kind of mitigate some of that, but again, as Romita mentioned, the one Form 5472 is a $25,000 penalty. For the FinCEN, if you don't file when you're supposed to, it's basically $10,000 per, technically per filing, let's say. And then similarly with a 1065, depending on the number of partners you have, if you have 100 partners or something, and there are specific penalties for each K1, so it's always, obviously we have deadlines in Canada, but you need to be very mindful of the timelines in the US, because there are deadlines because of these, sort of excessive penalties that they tend to impose.
Yeah, that penalty definitely does not sound trivial. So I guess some more questions about the annual upkeep. I guess with this cross-border structuring, does it affect the annual reporting obligations on both sides? I know you guys already touched on that a little bit, but any additional insights on that?
Yeah, I think you mean what are the rules that interact with the cross-border structure?
Mm-hmm. Yeah.
So there are several factors to consider here when it comes to cross-border business. There's always, again, potential of being taxed twice, which we already mentioned. And fortunately, there are mechanisms in place to mitigate such risk. And that is through treaty, because the treaty is designed to reduce this risk of double tax with the help of the foreign tax credit, because it ensures the income taxed in one country doesn't face additional tax in the other. So these mechanisms are there, and they are beneficial if you have this efficient structure in place. And just be aware that there is no one-size-fits-all approach. So it's always a good idea to get advice from both your tax and legal side on your structure, and just be informed what your tax and legal obligations are if you're conducting cross-border businesses. Yeah.
Got it. Thank you for that. And I guess in terms of like investment flexibility, if there's an investor or trader that wants access to margin accounts, or even potentially like, investing in different asset classes like crypto, does entity structure affect this? Or, curious if you guys have any thoughts on that. Like how does like the entity structure impact that flexibility?
Yeah, if you're investing through a corporation, let's say in the U.S., it might be easier to actually get financing from a U.S. lender. I assume they might still look for kind of personal guarantees, because again, if that Canadian shareholder is likely not going to have any kind of credit rating in the U.S. So that may happen. But again, I think it's easier when you have a corporate entity to otherwise get financing than, let's say, a partnership. It's just, and maybe it's based on some type of projection of income and something like that. But I usually find that with a corporation, it's easier to obtain financing. The other thing again is between the depending on kind of the nature of the investment, if we're just mainly looking at capital gains, then again, you're looking at probably, the partnership vehicle is probably better, because again, income earned in a corporation, there's no lower preferred tax rate on certain types of income. You're paying kind of a flat tax of 21%. So to some extent, again, depending on the nature of the income that's earned in the investment, may otherwise impact on potentially what structure you decide to go with. And in terms of capital flows, I'm assuming that just some maybe regulatory reporting, I would imagine it probably doesn't differ based on the investment structure. But again, just to be aware, again, in that cross-border context, that there might be some, bank reporting, because, if income is coming from the U.S., so just something to be, to be mindful of.
And okay, great. And I guess like the last question here, just any general advice or like best practice checklist or software tool, obviously Trowbridge services, but any recommendations that you would give to the audience for staying organized on all of these, annual upkeep, all these filings, and structuring the U.S. entity?
Yeah. Romita, I don't know if you want to talk about kind of the accounting side of it, perhaps, or.
Yeah, absolutely. In my opinion, if you are well positioned with setting up the infrastructure, such as if your bookkeeping is in place, simple things like if you ensure your transactions, like if you're doing a cross-border activity, the transactions are recorded in US or functional currency. If there's any financing, it's well documented, and making sure you are aware of the potential tax filing requirements on both sides of the border. So you have procedures in place to ensure the deadlines are tracked and filed on time. And overall, as a taxpayer, just be proactive, so you don't fall into the pits of unwary, right? Because whenever you trade or whenever you exercise or do conduct business across the border, there's always all these tax obligations and legal obligations that one must be always aware of before investing or doing anything. Yeah.
Yeah. So the other thing I would maybe mention, again, if this is someone that maybe a sophisticated investor, and depending on maybe where their financing is coming from, you sort of want to have a good handle in terms of kind of the flow of funds and the flow of borrowing funds. From a CRA perspective, they're pretty fussy in terms of looking at kind of like very much the tracking of the funds used for investment, and then otherwise if it's currently deductible from a Canadian tax perspective. So again, having, I guess as Romita kind of alluded to, having good kind of books and records to have for that tracking, again, in case there if there's like an audit or something from CR, just to make sure that you have proper documentation.
I guess lastly, I will also share some links in the chat with Trowbridge and Composer business accounts. But do you guys want to give just some last insights on what you guys like, what Trowbridge does, and what some of the services that you guys offer?
Yeah, so in terms of as Romita kind of mentioned, we're kind of on a kind of U.S. corporate tax team, although we also deal with individual tax. So in terms of kind of services we can offer is on the planning side, kind of on the initial setup. We can always refer a referral network of lawyers that can assist with any kind of incorporation. We can assist on the compliance side, so that's really the preparation of corporate tax returns, preparation of any partnership tax returns. Again, if the individual partners need to file any U.S. tax returns in the U.S., we can assist them with the preparation and filing of it. So basically a non-resident, a 1040-NR, which is basically a non-resident return for a Canadian person that needs to file something in the U.S. We also have certified agents at Trowbridge. So that's basically someone that can certify a passport for purposes of getting a individual taxpayer identification number. So again, you don't necessarily need to worry about giving up your passport. It's sort of a one-stop shop where we can get the number and also file the tax return, and then eventually you would get a number. So really, it's on, initially on the initial planning side. We can help on the compliance side, afterwards. And then same type of thing in terms of, maybe planning or consulting on maybe some type of exit strategy at some point in time, if it makes sense. So again, we can do, pretty much, again, the corporate side of it and also the individual U.S. tax side. And also Canadian. I don't personally do that, but also there's a Canadian corporate tax team that we have that does Canadian corporate tax and Canadian individual tax.
Awesome. And I will just give a quick brief into Composer business accounts. With Composer business accounts, you can, as Canadians, use Composer on our platform through Composer business accounts. So if you have a U.S. entity, you can sign up for Composer business accounts, and that will let you build fully automated trading strategies across stocks, ETFs, and crypto with intuitive no-code tools. And we can also connect you with experts like the Trowbridge team for entity structuring and tax reporting. Currently, we offer a free consultation. So in the chat here, I've linked the link to sign up for a free consultation. So feel free to go through that link and sign up. Really appreciate you guys for coming on and giving all these insights. With everybody who registered for the webinar, as well as people inside the Composer community, we'll be sending out a link with this recording and with follow-up emails next week with the recording and a YouTube link to this. So stay tuned for that. And also, please follow our newsletter and our socials because we will have another webinar in the next 2 weeks as well. So thanks again, Romita and Brandon.
Thank you.
Thanks so much for joining us. And have a great rest of your afternoons.
Take care.
Thank you.